people can trick themselves into thinking that, hey, this is okay because everybody else does it. But over the long term, just like you said, it just continues to add up. It continues to strip away from potential wealth that you could be building and utilizing for other great things that you want to do.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome into Your Life, Your Money, the podcast that tries to help you thrive in life, wealth, and retirement. Today we got a good topic. It's about mindsets. What kind of mindset do you have financially? Are you a borrower, a saver, an investor? We're going to go through these three types of mindsets, kind of explain why this is an important topic, and really go through each specific mindset and explain kind of what this mindset's all about, and if whether or not you can change your mindset if you want to do that as well. So we do that as always with Scott Searens, President and Financial Advisor at Searens Financial Group. Scott, good to talk to you again. How's it going?
Ben, things are great. Glad to be back on the podcast here.
Yeah, great to have you. If you haven't joined us, we are early in the process of the podcast, but we do appreciate the feedback we've gotten already. Again, you can find everything, too, that we do on lifemoneyshow.com. That is the website. We put all of our podcasts there, show notes, everything else, a link to contact Scott. Connect with him as well if you'd like to do that. Again, lifemoneyshow.com. Before we jump into the topic today, I found a quote that I thought was interesting. Maybe get a thought from you on it. But Robert Kiyosaki once said, "The only difference between a rich person and a poor person is how they spend their time."
Ben, that's a very interesting quote. And I think I would actually add to that quote, not only how they spend their time, but just exactly what we're going to talk about today, which is what are their mindsets and their actions with their money. And rich is a really relative term. You know, I think sometimes when we hear a quote like this and it says rich person, well, that's a really relative term. I mean, you could have $500,000 and you're rich because you're living within your means, or it could be $1 million or more and rich because, you know, you save, you invest, and again, you're living within your means. So that term's relative, but I think what he's saying here really comes into what we're going to talk about today. And it's how do you spend your time, but what's your mindset and what are the actions that you take with your money that can help create a difference for your future?
Yeah, I didn't even think about this quote tying in specifically to the topic, but it does make sense because, you know, that those actions and your mindset is part of how you spend your time, right? That is what you're doing with your time. So it's a great segue into our conversation today. So with these three mindsets, before we get into each one individually, why is this an important topic for people?
You know, I was having a conversation with a friend, and we got talking about, well, what is the difference? What has made the difference in some of your clients or clients that you feel that have, you know, a great path, a great direction in regards to their overall finances and financial futures. And it made me really think about how they act, how they think when it comes to money. And for all of us, we all have different ways that we act and think around money. A lot of them are, you know, habits or mindsets that we've developed. Sometimes we don't even know that it is a mindset that we have, right? I'm not sure if you've heard about the subconscious mind, right? But sometimes it's just maybe it's been developed in the subconscious mind because of, you know, things that we're following, or maybe it's just developed based on how you were raised. Maybe this is how your parents treated money or acted with money. And so now those are the ways that you act with money. So I think it's really it's important to understand these mindsets and really take some time, self-reflect, say, where do you stand today? How are you operating today with your money? And then where do you want to go? How do you want to change? If you want to change, maybe everything's going just fine for you, but if you want to change, how do you want to change and where do you want to go? And I think just like, you know, whether it be a bad habit that you have with a sport or just any bad habits in general, right? Habits are tough to break. So if you do want to change, you really have to get emotionally involved. You really have to think through this and go, okay, I am here and I want to go to this next mindset over here. I want to act differently with my money. And so I really look forward to our discussion. I think that'll help people self-reflect, say, okay, here's how I'm operating with my money now. I'm headed in a great path. Or here's how I'm operating with my money now. I want to switch to one of these other mindsets.
Great. Well, I think that gives everybody a good background on our discussion today and why it's so important and what you can be thinking about as we go through this. So we got three different mindsets to kind of break down. Let's begin with borrower. I think this is one that a lot of us fall into at some point in our life, right? We get into the mindset of borrow, especially when we get out of college and we actually have money. We start able to spend. We're responsible for our own actions. But let's talk about the borrower mindset first.
Yeah, so the borrower mindset is that mindset, and I'll kind of also relate it a little bit to a spender, right? Maybe somebody's spending outside of their means, but you're exactly right. I mean, when kind of entering into the world and say after high school or college, or as you kind of starting to live out on your own, boy, there's so much in the news and the media making money so easily available to you, whether it be through credit cards or through loans. And so one mindset that is out there as well is the borrower's mindset, meaning if you need a new car, you're going to go and borrow money to be able to own that new car. If you need to do renovations on your home, you're going to borrow money for that. Or if you want to go on vacation, you're going to borrow money for that. You're constantly borrowing, taking loans, trying to fit monthly payments within what your current income stream is. Now, two types of borrowing. I'll say that there's good debt or good borrowing. That could be borrowing on an appreciating asset like a home, meaning that as you're paying it off, hopefully the value or potentially the value of that home is going up while you're paying it off. So over time, are you losing money on that debt, on that borrowing? Hopefully not over a long period of time. But then there's bad debt or bad borrowing. Now, this could be for a car, vacations, boats, putting, things on credit cards, but then not paying those credit cards off in full monthly. So just making the minimum payments where you're paying interest back to the credit card company. It could be, getting gifts for folks that you can't maybe afford. So you get a loan or you put it on your credit card, or it could be new appliances on the, for the home. The reason I call this bad debt is you're actually now paying money to the bank just to have what you need, right? Just to get that loan to do that thing. And in the end, you'll never get that money back. You'll never see it back in appreciated value. I think a good example here is a car. So I just ran some numbers. I said, okay, what if you got a loan on a car, $25,000 car, and let's just say the rate was 3.5%. And you said, okay, I'm going to pay this off over 60 months. Well, that $25,000 car loan, you're actually, in the end, over that 60 months, in total, you would pay $27,287. And I say, well, gosh, that's just $2,287 more. But again, it's $2,287 more that you're paying now to somebody else. That's not money staying in your pocket. You're giving it to somebody else. On top of it, you have to remember that a car depreciates. So over 5 years, maybe that car is now only worth $10,000. So you've paid out $27,000 for something that's only worth $10,000 to you. I also ran some numbers just from a credit card standpoint. Let's just say you had a $10,000 balance on your credit card. Gosh, credit card rates are unbelievable. It was amazing when I was sitting there looking at them. I'm like, wow. I mean, the money that you would pay out to a credit card company is unbelievable. So I just kind of went middle of the road. What if you had a 15% interest rate and you said, okay, the only way, I'm just trying to make everything fit within my income, and so you're only paying $200 a month on this. You would end up paying $5,791 in interest to the bank.
Man, that's crazy.
Yeah. So, and that assumes, right? That assumes that you're not putting anything more on that credit card. And so it seems so easy. I think you kind of get trapped here. You get trapped thinking that, yes, hey, everything fits within your income, so everything's okay. It feels good. But you really forget how much of your hard-earned money that you're just turning over to somebody else.
Yeah, and I think about when you look at those credit card amounts, you think about, okay, I'm paying like $30 a month late fee or interest. You don't think about it month to month, but just how quickly it adds up and how much of a difference it makes over the long term is astounding.
You're exactly right. You don't think about how much it adds up. It feels comfortable. And back to kind of how we started, right? It's kind of that thought process of, well, everyone else does it. And I'm going to tell you, not everybody else actually does it, but that's what, when you see the articles or when you see something on the internet, it makes you feel like everybody else does it. Or it's that thought process of, well, everyone else has a car loan or a home renovation loan or this type of loan. And so people can trick themselves into thinking that, hey, this is okay because everybody else does it. But over the long term, just like you said, it just continues to add up. It continues to strip away from potential wealth that you could be building and utilizing for other great things that you want to do. And I think that probably transitions us into the next one, right? Because it's really going from that thought process of, okay, how do I just make everything fit inside of my income today, to how do I plan ahead for some of these different items? And I get it, there's emergencies, but even how do you plan ahead for potential emergencies?
Yeah, so that's the borrower mindset, and you mentioned the next one is saver. And this is, I guess, essentially almost the exact opposite of the borrower mentality, right? It's this stashing money away, really spending within your means. It's a completely different approach.
Yeah. So what is the saver? The saver is exactly what you said. It's somebody who's living within their means. They are taking from each and every paycheck that they get, and they're going to stash some away into their savings, into their checking. They're planning in advance for purchases. So if they need a car, they're going to say, hey, going to maybe need a car in 3 years or 5 years from now. They're going to say, okay, well, if I, want a car that costs $30,000, I'm going to need it in 3 years from now. I'm going to make sure that I've saved up at least $10,000 a year to be able to go out and pay cash for that car. Same thing with the vacation. They're not looking to, put a vacation on a credit card and pay for it over a long period of time. They're saving up for that vacation in advance to make sure when they're done with that vacation, everything's paid off, everything's done. So really that mindset of not spending it unless they have it. I see this a lot with, I'll say some of the baby boomers or people that are children of those that lived through the Depression, just because they want to make sure that they've got the money in the event that they need it. I think that they've seen other people suffer and go through hard times when it comes to their overall financial picture. They don't want that to be a part of their picture, so they're going to constantly make sure that they're saving money. The other thing, though, and I see this as well, is even for savers that have entered into retirement, they continue to stay savers. And this is something that I continue to work on with a lot of my clients, is that they have saved up a considerable amount of wealth for their retirement, and they have to learn a little bit of how to become spenders. That's why they've saved this money up. Now, overall, there's nothing wrong with being a saver. A quick little story. And this is actually where my mindset sat for a little bit of time, because this is how I was raised. So I talked earlier about, the habits that have developed from how you were raised. My parents were natural savers. So I became a natural saver as well. I really needed to kind of refocus, especially based on my age, to say, okay, well, how do you become an investor? Because being a saver is great. Frankly, I don't think that there's anything wrong with being a saver. Many of the savers out there, they're going to save a ton of money. They're going to figure out how to make that last for the rest of their lives. And they're going to always, maybe not always, but they're going to consistently, live within their means. But there are some opportunity cost with being a saver.
Right.
For instance, let's just talk about inflation. And I looked up some data on inflation here from inflationdata.com. So from 1913 to 2020, the average rate of inflation was 3.1%. Now, what is inflation? The inflation is the cost of goods going up, right? So if we're going out to the restaurant to buy a hamburger, or if we're going on vacation, the cost of what we're doing is going to continue to go up. So there is an opportunity cost from that standpoint, right? Because if there are a lot of savers, they might not necessarily like risk. So maybe they're trying to save all of their money in checking, savings, or CDs. Well, current CD rates are anywhere from 0.45% to 0.65%. So that's the trouble with focusing too much on savings, right? That inflation will outpace the growth that you're going to get in your savings accounts. So potential misses of opportunity if the money would have been invested.
Yeah, it's you definitely see that there are some negatives to oversaving, not to being a saver necessarily, but to oversaving. There's some things to be thinking about. Too conservative, might actually do you some harm over time that people just aren't paying attention to. So let's take it to that last mindset, which is a little bit different from each of the first two, but that's investor. What does this mindset consist of?
So I look at the investor as, somebody that they don't have any depreciating debt. They've saved from a savings standpoint, they've just saved for their emergencies. They've saved for upcoming purchases. But the investor is somebody who's really looking to put their money to work for them. So totally opposite of the borrower, right? The borrower is paying the institution for the money. The investor is now being paid because someone else is using their money. They're being paid in profits. They're being paid in interest. They might be paid through growth or appreciation. I just want to keep this really simple today so that you understand it and really think about being an investor. So let's just walk through buying a stock. Let's say you buy a stock, right? You own a share of a company. Now, if that company does well and they make a profit, because you bought a share of that company, they're going to pay you now a share of the profits through dividends. So, and if the company continues to do well, right, more people will want to own part of that company. And the other way that your money can grow is now that that company is doing well and more people want to own it, the value of that company is going to go up. So your money also appreciates from a growth standpoint. Another example would be real estate. Real estate, you invest in real estate, you put your money into real estate. Well, you may get property appreciation, so you could sell your real estate for profit. Or maybe you're investing in real estate from a rental property standpoint, and those rental properties are now paying you monthly income. So overall, right, you're taking your money, you're putting it to work for you, and now someone else is paying you an interest, profits, or growth and appreciation for your money. It's continuing to create more income for yourself. So again, that could be the stock market, that could be investing in real estate, investing in businesses. Now with investing, there are trade-offs. There's taking potential risk to get potential rewards. And we could do a whole nother podcast on that of, making sure that you're diversified, that you're invested in different categories, different asset classes, different items. So that way you're not putting all of your eggs into one basket. But this is how I see that people are really getting ahead with their money, shifting out of those other mindsets, right? Shifting out of that borrower mindset. Yes, having some savings. We want to make sure that they're prepared in the event of emergencies. They want to make sure that, if they have some upcoming purchases coming up, that those are saved for. But really now transitioning into being an investor, putting their money to work for them, and having someone else pay you for using your money.
I can definitely see there's pros and cons to every approach. I think borrower maybe has the least amount of pros potentially. But, when you look at this conversation, do you say you want to have a mix of mindsets? What's the ideal mindset? Or is it just kind of depend on what your goals are, what you hope to accomplish in retirement?
I'd say part of it is what your goals are. But if you ask me, hey, based on looking at folks that, are really putting themselves in the right position for their future, or now looking at folks that are, have saved up or invested for a lifetime and where they're at in their overall financial picture. And I would say that reducing debt or eliminating debt has given them this feeling of comfort, that they don't have to worry about any sort of payments. They really don't focus on, utilizing debt to own things. They're only going to pay for things where they have cash for it. They've saved up for emergencies just in case, right? They've got that reserve fund. They have kind of funds, different funds lined out for upcoming purchases. And then they've really transitioned themselves over to putting their money to work for them and investing the rest for their future, for their growth. And they're really thinking not only about themselves and what they need for their future, but they're building wealth for generations and generations to come.
Very good. Well, these are the mindsets that are most commonly found with people in their approach to finances. And, depending on where you fit and where you fall into this conversation, maybe you want to sit down with an advisor and kind of talk some of these things. How can you make some changes? How can you apply a different approach? How can you better use your time, right? That is the quote that we go back to at the beginning of this show. And if you want to do that, you can always find Scott online, lifemoneyshow.com. Very simple. There's a way to contact him there. But you can also check the show notes for this episode, plus listen to past episodes as well. So, Scott, it's a good conversation, and I think it does give people some things to think about. Are you taking the right approach? Do you have the right mindset? Are you fully using your time and applying it to your financial future?
Ben, and you brought up a great point. I think that, as we look to make change in our lives, sometimes change is scary. Change can be difficult. And so that's where you want to find somebody that can help you, that is a professional or that is educated in the area that you want to go to. So I get it. Investing sounds like risk. That could, that might be scary to some folks. So you find somebody that can help you out in that area to help you on the right path. So great points. Really enjoyed the discussion, and make it a great day.
Absolutely. Thanks for listening to this episode of Your Life, Your Money. We'll be back again in another couple of weeks for a new episode. We'll look forward to talking to you then.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.